Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Smithfield Foods Inc. Annual Report. Smithfield Foods Inc. offers a diverse range of businesses and services through its four main segments: packaged meats, fresh pork, hog production, and other. The company's packaged meat segment provides various packaged meat products to retail and food service customers under several brand names, including Smithfield, Eckrich, Nathan's Famous, and others. These products include bacon, sausage, hot dogs, deli meats, dry sausage, ham, ready-to-eat foods, and prepared meals. In addition to packaged meats, the company's fresh pork segment processes live hogs into various primal, subprimal, and offal products for retail, food service, industrial customers, and export markets. These products include bellies, butts, hams, loins, trimmings, picnics, and ribs. The hog production segment is responsible for producing and raising hogs on company-owned farms or contract farms. This segment also provides livestock feed and grains, as well as transportation and other ancillary services. Lastly, the other segment engages in bioscience operations that use raw materials from hogs to manufacture heparin products, including an active pharmaceutical ingredient that mitigates blood clot risk. The company also produces fresh pork products in Mexico through this segment. Overall, Smithfield Foods, Inc. offers a wide range of businesses and services across the meat industry, from packaged meats and fresh pork products to hog production and bioscience operations. Smithfield Foods, Inc. market capitalization of $10 billion is significantly larger than the average industry peer of roughly $0 billion. This shows that Smithfield Foods, Inc. holds a significant advantage in their industry. Smithfield Foods, Inc. trades at a lower price-to-earnings ratio of 10 times and a higher price-to-book ratio of 1.44 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company maintains a moderate leverage profile, with liabilities making up 45% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes, such as buybacks or dividends, rather than operational deterioration. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The company have a dividend yield of 5%. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline for a company can be attributed to various factors. On the growth side, sales contracts with customers, shipment/delivery terms of sales, customer sales incentive programs, and variable consideration estimates are key contributors. The closure of facilities and workforce reduction also led to revenue growth in certain instances. However, there are also several drivers that contribute to revenue decline. Intercompany sales decreased significantly, resulting in a substantial decline in revenue. The hog production reform, which involved ceasing certain farm operations and terminating agreements with underperforming contract farmers, also led to a decline in revenue. Additionally, the West Coast exit had a negative impact on revenue. It is worth noting that other factors such as net gains from derivatives and translation gains can also influence revenue growth or decline. Nevertheless, these drivers are not as significant as the ones mentioned above. Overall, understanding the primary drivers of revenue growth or decline is crucial for businesses to make informed decisions and develop strategies to mitigate potential risks and capitalize on opportunities. The net income of a company underwent significant changes between 2023 and 2025. In 2023, the company reported a net loss of $133 million, but this turned into a profit of $798 million in 2024. This marked an increase of $931 million from the previous year's loss to a substantial gain. However, in 2025, the net income decreased by $140 million compared to 2024. The changes in profit margins were also notable. The net income margin increased from 5.6% in 2024 to 6.4% in 2025, indicating an improvement in profitability. On the other hand, the adjusted EBITDA margin rose from 9.7% to 10.8% during the same period, further highlighting the company's improved financial performance. In contrast, the gross profit margin decreased slightly from 13.3% in 2024 to 13.4% in 2025. The operating profit margin also showed a significant increase, rising from -0.4% in 2023 to 8.3% in 2025. The mixed results of the company's profit margins can be attributed to various factors, including changes in market conditions and operational efficiency. Despite some fluctuations, the overall trend suggests that the company has made progress in improving its financial performance over the past 2 years. The company is generating significant positive operating cash flow. According to the financial reports, the net cash flow from operating activities of continuing operations has been consistently high over the past 3 years. In 2024, the company reported a net cash flow of $1,059 million, while in 2023, it was $916 million. Furthermore, the data confirms that the company generated positive operating cash flow in all 3 years, with the lowest amount being $688 million in 2023. This indicates a strong financial performance and ability to generate cash from its core operations. The company's debt level and interest expenses have undergone significant changes over the years. Initially, the debt level decreased by $18 million in 2022, but this trend was short-lived as it increased significantly due to large principal payments later that year. However, from 2024 to 2025, the total debt decreased, with a fair value reduction of $77 million or $104 million. The interest expenses also fluctuated during this period. While they decreased by $25 million in 2025, representing a 38.1% drop, there was an increase of 175% from 2023 to 2024. This indicates that the company's debt level and interest expenses have been subject to significant changes over time. In terms of long-term trends, the data suggests that the debt level has decreased significantly from 2026 to 2030. However, the interest expenses do not show a consistent trend, with both decreases and increases observed during this period. Overall, the company's financial situation is complex, with multiple factors influencing its debt level and interest expenses. The performance of various segments and regions in the industry can be summarized as follows. North America, particularly the U.S. packaged meats market, demonstrated strong performance due to long-term secular tailwinds. Global export markets also showed a strong performance with significant demand for U.S. pork exports. Regions outside of North America did not perform poorly, but may be impacted by global trends and consumer preferences. On the other hand, certain regions and segments are facing potential risks or have no specific performance metrics mentioned. China is one such region that faced tariffs ranging from 25% to 47%. Mexico and Canada, being among the largest export markets, lack specific performance metrics. The packaged meats market in Mexico, fresh pork, hog production, and bioscience sectors also do not have any performance metrics mentioned. These regions and segments are likely to be impacted by various factors such as global trends, consumer preferences, and trade policies. Smithfield Foods management is optimistic about the company's outlook, citing strong financial performance in recent years. The company has reported increasing revenue and earnings, which is a testament to its success. Management is focused on optimizing manufacturing footprint, consolidating production across the network, and investing in new technologies such as AI and RPA to drive improvements in operational efficiency and productivity. In terms of strategy, Smithfield Foods is committed to streamlining operations through workforce reduction initiatives and improving operational and cost efficiencies. The company has also committed funds for approved capital expenditure projects, which will help to support its growth plans. While there are no mentions of expanding into new markets or geographies, management's focus on investing in technology and streamlining operations suggests that the company is looking to drive growth through internal improvements. Overall, Smithfield Foods appears to be a well-established company with a strong financial performance and a clear strategy for driving growth and improvement. Management's commitment to investing in technology and streamlining operations suggests that the company is well-positioned for continued success in the future. Acquisitions and divestitures overview. The company has made several significant transactions in recent times. One notable acquisition is the pending purchase of Nathan's Famous for an estimated $450–500 million. This deal is subject to review by the Committee on Foreign Investment in the United States, CFIUS. The proposed acquisition highlights the company's expansion efforts. In addition to acquisitions, the company has also engaged in divestitures. A significant component of its business was sold off, although specific details are not provided. WH Group retained 87% of its outstanding shares after selling approximately 13% to investors. Furthermore, the company sold a substantial number of shares through its subsidiary, SFDS UK. The Monarch sale notice indicates that TPG may require Monarch to purchase its ownership interest in the company. This transaction is contingent on various conditions and highlights the complexities involved in corporate restructuring. Overall, these acquisitions and divestitures demonstrate the company's efforts to adapt and grow in a rapidly changing market. The company's financial activities have been transparent in their annual reports. One notable aspect is the payment of dividends to its shareholders. According to the provided references on pages 56 and 161, the company has indeed paid dividends, indicating a commitment to rewarding its investors. On the other hand, the company has not engaged in share buybacks. The absence of any mention of share repurchases in the specified pages, 39, 40, 42, 47, 97, and 99, suggests that the company has chosen not to utilize this strategy for managing its capital or increasing shareholder value. Concerns about inventory buildup and supply chain disruption are prevalent in various aspects of business operations. One major concern is the potential for inventory buildup due to seasonal demand fluctuations, as seen on page 7. This can lead to a surplus of products that may not be sold before they expire or become obsolete. Another significant concern is the risk of supply chain disruptions caused by factors such as production facility closures, distribution center issues, and raw material shortages. These disruptions can have far-reaching consequences, including increased costs, reduced availability of products, and damage to reputation. Pages 16, 19, 23. Disease outbreaks such as avian influenza and African swine fever can also lead to supply chain disruptions due to import/export restrictions. Page 21. Furthermore, product recalls or withdrawals, equipment failures, and prolonged power outages can all contribute to inventory buildup and supply chain disruption. Pages 23, 24. Regulatory changes, government actions, natural disasters, and extreme weather conditions can also impact supply chains, leading to disruptions in shipping, reduced availability of freight transportation, and increased distribution costs. Pages 27, 34, 38. The financial implications of these disruptions are evident, with inventory buildup reaching $43 million by page 148. Overall, the concerns about inventory buildup and supply chain disruption highlight the need for businesses to be proactive in managing their supply chains and mitigating potential risks. That concludes the financial summary for Smithfield Foods Inc. Feel free to comment below, and I will be happy to answer them when possible.